A once-in-a-lifetime economic reset is coming. Guys, we need to talk about what's happening in markets right now because something absolutely massive is playing out. And if you're not paying attention to where money is actually flowing, you're missing one of the clearest rotation signals we've seen in decades. What I'm about to show you isn't just another market dip or correction. This is a fundamental restructuring of how capital is being allocated across the entire economy. That's happening for very specific reasons that I'm going to break down for you. And here's what's really interesting. While everyone's panicking about tech stocks getting crushed and Bitcoin falling off a cliff, there's a specific category of stocks that's quietly attracting massive institutional money. These are names that have been completely left for dead while everyone chased AI, but they're about to have their moment for very specific reasons we're going to dig into. And by the end of this video, you're going to understand exactly why these plays are some of the most compelling opportunities in this entire rotation. And I'm going to give you the specific tickers that are positioned to benefit. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. And if you want access to my best trade of the day, based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. And if you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios that YouTube can sometimes restrict on its platform. The link's in the description below. As always, this is not financial advice. Do your own research. Now let's get into it. So here's what I'm seeing right now, and it's honestly incredible when you step back and look at the full picture. We've got consumer staples going up. We've got airlines going up. We've got cruise lines going up. Transportation and logistics stocks are climbing. And at the exact same time, big tech is getting absolutely demolished and Bitcoin is in free fall. Bitcoin just dropped below, 80,000, its lowest level since November of 2024, and it's showing no signs of stopping. Now, if you're newer to markets, you might be looking at this thinking, wait, how does that make any sense? How can defensive plays like consumer staples be going up at the same time as cyclical plays like airlines and cruise lines? Aren't those supposed to move in opposite directions? And why are the stocks that everyone's been piling into for the last 2 years suddenly getting destroyed? Well, what we're seeing right now is a broad market rotation, and it's not just one simple story. It's simple overlapping dynamics happening all at once, and understanding each piece is going to position you to make serious money while everyone else is confused and scared. But before we get into where the money is going, we need to understand what just triggered this entire cascade, because there's a very specific event that lit the fuse in all of this, and that event was the appointment of Kevin Warsh as the likely next Federal Reserve chairman. Now, you might be thinking, okay, new Fed chair, so what? We get new Fed chairs all the time. But Kevin Warsh is fundamentally different, and the market knows it. Warsh has a very specific reputation. He's what you'd call a deflation hawk. He served on the Federal Reserve Board during the 2008 financial crisis, and his track record shows that he is absolutely unwilling to run the money printer to bail out markets. This is absolutely critical to understand. Most people think that when the Fed cuts interest rates, that's good for stocks, that's good for Bitcoin, that's good for risk assets. And normally they'd be right, but cutting rates and printing money are two completely different things. You can cut rates to zero and still not print money. And if you're not printing money in a deflationary environment, you're not saving risk assets. You're letting them collapse. Let me show you exactly what happened. In just the last 6 days, 6 calendar days, look at what sold off. With silver down almost half. Bitcoin down like a quarter, gold down 12%, Microsoft down 9%, the NASDAQ 100 down 5%, all in 6 days. What do all of these have in common? They're all leveraged protections against money printing. They're all assets that people hold because they expect the Fed to devalue the dollar through inflation. But if the Fed isn't going to print money, if we're going to a deflationary regime instead, then all these assets become massively overvalued overnight. And the market figured this out immediately. The rush for the assets began the very next day, after Trump appointed Kevin Warsh. So let's talk about what's getting absolutely destroyed right now, because that's the starting point for understanding where the smart money is going. Big tech, specifically the mega cap names that have dominated market performance for the last couple of years, it's undergoing massive profit taking and reallocation. We're talking about the stocks that make up a huge portion of the S&P 500, the Mag 7, Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, Tesla. These 7 stocks alone represent 1/3 of the entire S&P 500. That's an insane level of concentration. Over half of the S&P 500's performance over the last 18 months came almost solely from these 7 stocks. It's not healthy market breadth. That's massive concentration risk. And what happens when you have that much money concentrated in such a small number of names? Eventually, the big institutional players have to rebalance. We're talking about giants like BlackRock and Vanguard. When you're overweight in a sector by that much, you have to sell your winning positions to maintain your target allocations. And once these massive funds decide to start rebalancing, that's just how the trade goes, because these players are so enormous that their flows literally move markets. And it's not just the mega cap tech names themselves. We're also seeing AI software stocks getting absolutely annihilated. The software ETF had its worst month since 2008, dropped 15% in January alone, and it's going to drop a lot more throughout February. Sentiment on software is the worst it's been in years. In fact, hedge funds have made $24 billion shorting software stocks so far in 2026, and we're barely into February. And here's the kicker. They're not taking profits and walking away. They're doubling down. They're massively increasing their short positions because they know there's significantly more downside to come. Why is this happening? It's actually very straightforward. There's growing uncertainty that AI itself is going to destroy these traditional software businesses. The old business model was beautiful for these companies. Build your software once, sell licenses forever, get recurring revenue streams. It was a money printing machine, but now AI can replicate what a lot of these software companies that charge tens of thousands of dollars do, and AI does it for cents on the dollar in one integrated platform. Just this week, new AI capabilities rolled out that can replace entire software workflows, legal software, document processing, data analytics. AI can now handle it all in one platform. After that was announced, the selling started immediately in legal software names. Then it spread across the entire sector like wildfire. You're seeing companies like ServiceNow down 28% year to date, Salesforce down 26%, Intuit down 34%, Adobe, Oracle, DocuSign, Workday, HubSpot, all hitting 52-week lows. Software's getting destroyed. And this is just the beginning. But it's not just software. We're also seeing massive carnage in high-debt AI infrastructure plays. Tech companies, they borrowed $121 billion in 2025, 4 times the average of the last 5 years. And where's all that money going? AI infrastructure. Tech companies are now spending 94% of their operating cash flow on AI infrastructure. Think about that. Almost every dollar they make is going right back into AI. And here's the problem. A study from MIT found 95% of companies investing in AI are seeing zero return on their investment. Zero. We're talking about $30 to $40 billion in enterprise AI spending with almost no measurable return. And now the market's saying, show us the money or we're going to destroy your stock, period. Look at what happened to Amazon. They just reported earnings. They actually beat on earnings. They beat on revenue. AWS sales were up, but their stock crashed over 10% in after hours. Why? Because instead of spending $146 billion on capital expenditures, they announced they're actually going to spend $200 billion. That's 37% more. And investors are asking the right question. Where is all this money going to come from? Google's expected to be cash flow neutral soon. Meta's running low on available cash. Amazon's starting to run low on available cash. And if we're going into a deleveraging regime where people don't want to lend anymore, where's the funding going to come from for all this AI build out? This is where it gets really dangerous because a lot of this AI infrastructure spending has been funded through private credit, and private credit is getting absolutely obliterated right now. The Financial Times just reported that banks are desperately trying to find buyers for tens of billions of dollars of loans tied to Oracle's data center projects. They've tapped every project finance bank possible, and now they're going to rating agencies begging them to call this debt institutional grade so they can dump it on pension funds and insurance companies. Private credit funds are getting crushed. Some are down over 11% in a single day, others down over 50% from their peaks. Imagine being a company whose stock is down 50% trying to raise money in a deleveraging environment where Kevin Warsh is ushering in a deflationary regime. Nobody wants that debt, nobody. And this creates what's called a doom loop. Let me explain how this works because it's absolutely critical to understanding why everything is selling off so aggressively. When markets drop and you have leveraged products like triple leverage ETFs, the problem compounds exponentially. Take TQQQ, which is a 3 times leveraged NASDAQ fund. When the market falls 3.33%, TQQQ is down 10%. But the way they achieve that triple exposure is with debt. When the market goes down and their debt level stays the same, they're not actually 3 times leveraged anymore. They could be 4 times leveraged. So what do they have to do? They have to sell the underlying stocks to rebalance. And that selling creates more downward pressure, which triggers more forced selling the next day, which creates more downward pressure. It's a self-reinforcing doom loop that feeds on itself. And we're seeing this play out in real time. Look at 2 times leveraged silver. It ran up over the course of a year and a half, and it's crashed over 60% in just 6 days. 6 days. That's the doom loop in action. These leveraged ETFs are getting forced to sell at the bottom, which triggers prices to go down even more, which triggers even more forced selling the next day. And it's not just leveraged ETFs. Individual investors have massive exposure to margin debt right now. Margin debt has surged 36.3% over the last year. We're now at an all-time record high of $1.225 trillion in margin debt. And when markets start dropping and people get margin calls, they're forced to sell, which creates more selling pressure, which triggers more margin calls. Another doom loop. We just saw $18 billion of forced selling in a single day. That's the 10th largest forced selling event ever. So that's what's getting crushed. Big tech, AI software, high debt AI infrastructure, crypto, leverage products, all getting absolutely destroyed. Now let's talk about where the money is actually going, because this is where it gets really exciting and where you can position yourself to make serious money from this rotation. First, consumer staples. Consumer staples are companies that produce and sell essential goods, food, beverages, household products, personal care items. Companies like Procter & Gamble, Coca-Cola, Pepsi, Colgate-Palmolive, General Mills. These are defensive stocks, and they perform well when investors are worried about economic uncertainty because people buy these products regardless of economic conditions. You still need toothpaste and laundry detergent, whether the economy is booming or in recession. So why are consumer staples going up right now? 3 clear reasons. First, there's real economic uncertainty. We've had a massive run-up in tech and AI stocks, and now there are serious questions about whether all the AI spending is actually going to generate returns. Investors are getting cautious, and when that happens, they rotate into defensive positions. It's that simple. Second, these stocks have been significantly undervalued relative to the rest of the market for quite a while. When tech stocks are going parabolic, nobody wants to own boring companies that grow earnings by 3 or 4% a year. But now that tech's getting hit, those stable, predictable cash flows look extremely attractive. Third, many of these consumer staples companies have strong dividend yields. When you're worried about capital appreciation in growth stocks, you start looking for income. And consumer staples deliver that consistently. So money is flooding into consumer staples as a defensive play. Investors are saying, look, I don't know what's going to happen with AI and tech over the next 6 months, so I'm going to park money in companies that have stable businesses and pay me dividends while I wait. Now, at the same time, this is where it gets really interesting. We're seeing money flow into what appears to be much more cyclical plays: airlines, cruise lines, transportation, logistics. These are the exact opposite of defensive stocks. These are companies that do well when the economy is strong and consumer spending is robust. So how do you explain consumer staples and airlines both going up at the same time? Well, here's where you have to understand that we're dealing with multiple investor bases making different bets based on different timeframes and different risk tolerances. The money going into consumer staples is coming from investors who are worried about near-term volatility and want safety. The money going to airlines and cruise lines is coming from investors who are looking 6 to 12 months out and saying, Okay, we've had this massive concentration in tech, but the broader economy is actually still in solid shape. Employment, while showing some cracks, is still relatively strong. Consumer balance sheets are healthier than expected, and these cyclical stocks have been beaten down and overlooked while everyone was chasing AI. Airlines and cruise lines specifically are incredibly interesting right now because they've been absolutely hated for years. Airlines went through hell during COVID. Cruise lines were essentially shut down completely. Both industries had to take on massive amounts of debt just to survive. And even as travel came roaring back, investors stayed skeptical. They didn't want to own these names because they're viewed as high debt, low margin, cyclical businesses. But here's what's changed. These companies have been aggressively paying down debt. They've been improving their balance sheets dramatically. They've been demonstrating real pricing power. And demand for travel, especially international travel and cruise bookings, has remained surprisingly strong. So you've got a perfect setup where these stocks have been left for dead. Their valuations are still incredibly low. Their businesses have actually improved significantly. And now investors are starting to recognize the value here. It's a textbook value rotation. Money's coming out of expensive, high multiple tech stocks and flooding into cheaper, undervalued cyclical names that have actual earnings and cash flow. Transportation and logistics stocks are the same story. These are companies like freight railroads, trucking companies, logistics providers. They benefit from economic activity and goods movement. They've been undervalued because everyone assumed that e-commerce growth was slowing and that we were heading into a recession, but e-commerce hasn't slowed as much as people feared. And the recession that everyone was predicting for the last 2 years hasn't materialized yet. So now investors are looking at these transportation and logistics names and realizing they're trading at incredibly attractive valuations for companies that have stable businesses and generate solid free cash flow. There's also a critical thematic element here. A lot of money is flowing into what people are calling the physical economy. After years of obsessing over digital and software, there's growing recognition that the physical world still matters enormously. You still need planes to fly people. You still need ships to move goods. You still need trucks and trains to deliver products. The AI boom itself, ironically, requires massive physical infrastructure. Data centers need to be built. They need copper wiring. They need cooling systems. They need power. All that physical infrastructure benefits materials companies, industrial companies, energy companies, transportation companies. We're seeing basic materials up over 9% year to date. Energy up 13%. These are sectors that have been completely ignored while everyone was chasing software and AI, and now they're dramatically outperforming. So part of what we're seeing is a major rotation from digital economy stocks into physical economy stocks. And that brings me to another area where I'm seeing serious money rotate. And this is one of the most compelling opportunities that most people are completely missing. And that's pharmaceuticals. Now, pharma hasn't been getting the same kind of attention as airlines or consumer staples, but if you look at the flows, money is definitely moving into this sector. And there are very compelling reasons why. Pharma is another area that's been overlooked while everyone was chasing tech and AI. These are companies with real earnings, real cash flows, strong balance sheets, and in many cases, really attractive dividend yields. They also benefit from structural tailwinds that aren't going away regardless of what happens with the economy. The population is aging, which means more demand for healthcare and pharmaceuticals. We're seeing genuine innovation in areas like obesity drugs, cancer treatments, Alzheimer's research, and unlike software companies that are worried about AI disrupting their business models, pharma companies are actually using AI to accelerate drug discovery, but they're not at risk of being replaced by AI. You can't download a pill, you can't have ChatGPT cure your disease. Pharmaceuticals are physical products that require massive R&D, regulatory approval, manufacturing infrastructure, distribution networks. These are real businesses with massive barriers to entry. Now, let me get very specific here because there's 2 pharmaceutical stocks in particular that represent exceptional opportunities in this rotation. And they both have near-term catalysts that are going to drive significant upside. Bristol Myers Squibb, ticker BMY, and Biogen, ticker PILB. Let's start with Bristol Myers Squibb because this is one of the most undervalued large cap pharma names in the market right now. And there are very specific reasons why this stock is going to move significantly higher in the near future. Bristol Myers Squibb is a massive pharmaceutical company with market cap around $50 billion. They're diversified across multiple therapeutic areas, including cancer treatments, immunology, cardiovascular, and blood disorders. They've got a portfolio of blockbuster drugs, including their blood thinner that does over 10 billion in annual sales, multiple cancer treatments, and treatments for blood cancers. Now, the stock's been absolutely beaten down over the past couple of years. It's trading near multi-year lows, and the reason's straightforward. Investors have been worried about what's called the patent cliff. Some of their biggest revenue generators started losing patent exclusivity, and generic competition has been eating into sales. The market has basically priced Bristol Myers as a company in decline, a company that's going to see revenue and earnings shrink as their older drugs go off patent. But here's what the market's completely missing. Bristol Myers has been extremely aggressive about building out their pipeline to replace that lost revenue. They've made strategic acquisitions. They've been investing billions into R&D, and now that pipeline's starting to pay off in a big way. They've got multiple drugs in late-stage development that have blockbuster potential. They've got treatments for heart disease that are already approved and ramping up sales faster than expected. They've got treatments for blood disorders that are showing really strong growth. They've got treatments for skin conditions that just launched, and early uptake's been excellent. They've got advanced cancer therapies that are gaining serious traction, and they've got several drugs in their pipeline that are going to get approved in the next 12 to 18 months. Now, here's why this matters for the stock price. The market is currently pricing Bristol Myers as if their revenue is going to decline or stay flat. But if these new drugs continue to ramp up the way they have been, Bristol Myers is going to show revenue growth in 2026 and 2027. It's going to be a massive re-rating event for the stock. Analysts who've been bearish are going to have to upgrade their price targets. Institutional investors who've been avoiding the stock are going to have to reconsider. And remember, this is happening at a time when Bristol Myers is trading at an incredibly cheap valuation. The stock's trading at around 8 times forward earnings. Compare that to the broader market trading at 20 times earnings. You're getting a 75% discount to the market multiple for a company with a diversified revenue base, a strong pipeline, and improving fundamentals. On top of that, Bristol Myers pays a dividend yield of over 4.5%. In a deflationary environment where investors are looking for income and safety, that dividend becomes extremely attractive. And the dividend is very well covered by earnings and cash flow, so there's zero risk of a cut. In fact, they've been consistently raising the dividend over time. Now, let's talk about near-term catalysts, because this is where it gets really exciting for BMY. First, they're going to be reporting clinical trial data for several of their pipeline drugs over the next few months. If any of these trials show positive results, and I expect they will, that's going to be a significant catalyst for the stock. The market is not pricing in success for these trials, so any positive surprise is going to drive the stock meaningfully higher. Second, we're getting closer to the point where the patent cliff impact is going to start its anniversary, and once that company patents lapse, revenue comparisons are going to start to look better, and the narrative around the stock will shift from declining revenue to stabilizing or growing revenue. Third, there's increasing speculation about potential merger and acquisition activity in the pharma sector. Bristol Myers has a strong balance sheet and generates a lot of cash. They could be an acquirer of smaller biotech companies with promising drugs, which would add to their pipeline. Or alternatively, given how cheap the stock is trading, there's been some speculation that Bristol Myers itself could be an acquisition target for a larger company, though I think that's less likely given their size. Fourth, this is macro. We're in an environment where defensive stocks with strong dividends are coming back into favor in a big way. Bristol Myers checks all those boxes. As money continues to rotate out of tech and into more defensive names, pharma stocks like Bristol Myers are natural beneficiaries. Fifth, there's a political element here that's underappreciated. The Trump administration has been talking about bringing drug manufacturing back to the United States, about reducing dependence on China for pharmaceutical ingredients, about supporting domestic pharma companies. Bristol Myers, as a large US-based pharmaceutical company with significant domestic manufacturing, is going to benefit from any policies that support the domestic pharma industry. Now let me contrast this with Biogen, which is a similar story with some different dynamics that make it equally compelling. Biogen, ticker BIIB, is another pharma stock that's been absolutely left for dead. Stock's down significantly from its highs a few years ago. Biogen's focused specifically on brain and nervous system diseases, particularly treatments for neurological diseases like multiple sclerosis, Alzheimer's, and rare genetic conditions. The reason Biogen's stock has been crushed is because they had some major setbacks. Their first Alzheimer's drug was controversial. The FDA approved it, but there was a lot of debate about whether the clinical data actually supported approval. Medicare limited reimbursement for it, which basically killed the commercial opportunity. Investors lost confidence in the company's pipeline and in management's ability to execute. But here's what's changed. Biogen has a new Alzheimer's drug that they're co-developing with a partner. This drug is fundamentally different. The clinical data for this new treatment actually shows meaningful benefit in slowing cognitive decline in Alzheimer's patients. The FDA has granted full approval, and critically, Medicare has agreed to cover it for appropriate patients. This is a huge deal. Alzheimer's affects millions of people, and if this treatment becomes a standard of care, we're talking about a multi-billion-dollar annual revenue opportunity. Now, the drug is still in early launch phase. Sales are ramping up slowly because there's a lot of logistics involved in getting patients diagnosed, getting them on treatment, monitoring them. But the trajectory is very positive. Prescriptions are growing quarter over quarter. Awareness among doctors is increasing. Reimbursement's expanding. If this launch continues to execute well over the next 12 to 24 months, this drug alone is going to completely change the financial profile of Biogen. On top of that, Biogen still has their legacy multiple sclerosis business, which generates steady revenue and cash flow. They've got treatments for rare genetic conditions, which is a strong franchise. They've got other drugs in their pipeline for neurological conditions. Stock's currently trading around 9 times forward earnings, with a dividend yield around 3.5%. Again, this is incredibly cheap for a company with potential blockbuster drugs in the pipeline. The market's basically saying, we don't believe the Alzheimer's drug is going to be successful, or we don't think it's going to move the needle financially. But if it does, and I believe it will, the stock is going to easily re-rate 20, 30, 40% higher from current levels. Near-term catalysts for Biogen are similar to Bristol Myers. They're going to be reporting sales data for their Alzheimer's treatment every quarter. And if those sales numbers continue to accelerate, and they will, that's going to force analysts to raise their revenue and earnings estimates, which drives price targets higher. They're also going to be presenting more clinical data on their pipeline drugs at medical conferences over the next several months. Any positive data is a catalyst. And again, Biogen benefits from the same macro rotation we're seeing. Money flowing out of speculative tech and into pharma stocks with real products, real revenue, strong balance sheets, and dividend yields. Now let me compare these two stocks side by side because it helps illustrate the opportunity. Bristol Myers is a larger, more diversified play. They've got multiple drugs across multiple therapeutic areas. Lower risk in some ways because they're not dependent on any single drug, but also potentially lower upside because they're a bigger ship that turns more slowly. Biogen's smaller, more concentrated in brain and nervous system diseases. Higher risk because they're more dependent on the success of their Alzheimer's treatment and a few other key drugs, but potentially higher upside if those drugs succeed. Both stocks are trading at single-digit price-to-earnings ratio, which is absurdly cheap by historical standards, and compared to the broader market, both pay dividends in the 3.5% to 4.5% range. Both have strong balance sheets with manageable debt and generate significant cash flow. Both are using AI to accelerate drug discovery, but aren't at risk of being disrupted by AI software companies. Both benefit from aging demographics, which drive increasing demand for pharmaceuticals. Both have near-term catalysts in the form of clinical data readouts and quarterly earnings reports that are going to drive the stock higher. And both are benefiting from this broader rotation out of tech and into more defensive, value-oriented names. The risk with both these stocks, and I want to be clear about this, is clinical and commercial execution. Drug development carries risk. Clinical trials can fail. Drugs get approved but don't sell as well as expected. Competitive dynamics change. Regulatory environments shift. These are real risks they need to be aware of. But here's my view, and I'm very confident in this. The market's currently pricing both Bristol Myers and Biogen as if things are going to go wrong, as if their pipelines are going to fail, as if their new drugs aren't going to ramp. And that creates massive asymmetry. If things go even moderately well, if their drugs perform even reasonably in line with expectations, these stocks are going to re-rate significantly higher
You're getting paid a 4% dividend to wait and see how it plays out. Compare that to holding a tech stock that pays no dividend, is down 30% year to date, has massive debt, and has a huge business model hole that might get disrupted using AI. The risk reward in pharma looks way more attractive in this environment. And let me pull this all together and show you how pharmaceutical stocks like Bristol Myers and Biogen fit into the broader rotation we've been talking about. What we're witnessing is a massive shift in market leadership. For the last 2 years, market's been dominated by a handful of mega cap tech stocks and AI plays. Those stocks have traded at premium valuations based on the promise of future growth. Investors were willing to pay 30, 40, 50 times earnings or more because they believed these companies were going to grow earnings at 20, 30, 40% annually. But that narrative's breaking down completely. We're seeing clear evidence that AI spending isn't generating the returns people expected. We're seeing companies pile on massive debt to fund capital expenditures that may not pay off. We're seeing a deflationary regime take hold under Kevin Warsh, which makes debt toxic and puts massive pressure on high valuation growth stocks. So money's rotating out of those expensive, leveraged plays and into cheaper, safer, more defensive plays, actual earnings and cash flow, consumer staples, industrials, basic materials, energy, financials, airlines and cruise lines, and the cyclical side, and pharma. Pharma fits perfectly into this rotation because it combines defensive characteristics with growth potential at reasonable valuations. Bristol Myers and Biogen aren't going to triple overnight, but they don't need to. They can grow revenue by 5 to 10% annually, maintain margins, pay their dividends, and the market re-rates them from 8 times earnings to 12 times earnings, which is still cheap. You're looking at 50% upside plus the dividend yield. That's a very attractive risk-reward profile in an environment where a lot of other assets are going down. And the timing is particularly interesting because we're still early in this rotation. Pharma stocks have started to move higher, but they haven't gone parabolic. There's still opportunity to get in at reasonable prices before the momentum really accelerates. Over the next 6 to 12 months, as tech continues to struggle and as pharma companies continue to report solid earnings and pipeline progress, we're going to see increasing institutional interest in these names. And that institutional buying is what drives sustained moves higher. Let me tie all this together because I know we've covered a lot of ground. What we're witnessing right now is a classic broad market rotation, but it's not just one simple trade. It's multiple overlapping rotations happening simultaneously, all triggered by this expectation of a deflationary regime under Kevin Warsh. You get a rotation from growth to value. Tech stocks, especially AI and software, have been trading at enormous multiples based on expectations of future growth. Now investors are questioning those growth assumptions and rotating the stocks with lower multiples and more certain earnings. You've got a rotation from concentration to diversification. The market was insanely concentrated in a handful of mega cap tech names. Now, institutional investors are being forced to rebalance. And that money is spreading out among the broader market. You've got a rotation from digital to physical. After years of believing that software was eating the world, investors are remembering that the physical world still matters enormously. Materials, industrials, energy, transportation. These sectors are benefiting. You've got a rotation from offensive to defensive. Investors are worried about near-term volatility and economic uncertainty. So they're moving into consumer staples, pharmaceuticals, and dividend bank stocks that provide safety and income. You've got a rotation from a leverage to deleveraging. In a deflationary environment, debt becomes toxic. Every dollar of deflation means you have to work harder to pay off that debt. So investors are fleeing leveraged products. And companies with high debt loads are getting crushed. You've got a rotation based on valuation. Investors are looking for better deals. They're selling expensive stocks and buying cheaper stocks with actual earnings and cash flow. And pharmaceutical stocks like Bristol Myers Squibb and Biogen sit right at the intersection of all these rotations. Their value plays trading at single-digit multiples. They're defensive with stable demand and dividend income. They have no excessive debt and strong balance sheets, so they benefit from deleveraging. They have physical products that can't be disrupted by AI. They're diversified away from the concentration in tech. And they have near-term catalysts that are going to drive the stocks higher, even as the broader market struggles. Now, here's what this means for you as an investor. If you're holding positions in the areas that are getting crushed right now, big tech, AI software, crypto, leverage products, You need to ask yourself a serious question. Do you have long-term conviction in these specific companies? Or were you just riding momentum? If you're holding names that don't have strong fundamentals, that have high debt, that are essentially just hype plays, cut those positions. The momentum is shifted, and these stocks have a lot further to fall. We're not even at zero interest rates yet. We're not at the point that the Fed starts printing money again. That's when you get the buy signal. That's when you want to start thinking about taking on debt again and buying risk assets. We're not there yet. We're in the deleveraging phase. This is when you reduce debt, increase cash, position yourself in defensive names that can hold up or even go up while everything else is going down. On the other hand, if you're holding high quality companies in these sectors that have real competitive advantages, strong balance sheets, proven business models, companies that you generally believe in for the long term, they might just be getting dragged down with the broader sector rotation. And that could be an opportunity to add to those positions at better prices if you have the conviction in the capital. But the bigger opportunity right now is recognizing where the money is flowing and positioning yourself accordingly. Small caps are outperforming, basic materials and industrials are surging. Energy is strong, financials are benefiting, consumer staples are getting defensive flows. Airlines, crew lines, transportations are getting cyclical flows, and pharma is attracting serious institutional money from investors looking for quality at reasonable prices with dividend income and defensive characteristics. If you're not exposed to at least some of these sectors, you're missing the shift. And specifically, if you're not looking at pharmaceutical names like Bristol Myers Squibb, Biogen, you're missing what is one of the best risk opportunities in this entire rotation. Now, I want to be very clear. I'm not your financial advisor. This isn't personalized financial advice or a recommendation to buy or sell any specific security. You need to do your own research. You need to understand your own risk tolerance and investment timeframes. What I am saying is what the setup here is, and it's compelling. The rotation's real, the flows are happening, and pharmaceutical stocks are benefiting in a very meaningful way. Rotations like this, when the market's crashing or when stocks are suddenly a bad investment, it doesn't mean all stocks are. Rotations are healthy. They allow markets to breathe. Markets just can't go up in a straight line forever with all the gains concentrated in 7 stocks. That's not sustainable. Over the long term, if you're buying good companies at good prices, you're going to do well. But in the medium term, understanding these rotation dynamics can help you avoid unnecessary pain and take advantage of massive opportunities. The media is going to try to scare you. They're going to run headlines about tech crashes and market turmoil and the end of the bull market. Don't let that drive emotional decisions. Focus on the facts, understand where money is flowing and why, and make rational decisions based on your own time frames and risk tolerance. And remember, this is a transition phase. We're moving from one regime to another, from an inflationary, money printing growth at any cost regime to a deflationary, deleveraging, show me the earnings regime. That transition is going to be painful. There's going to be volatility. But on the other side of this transition, there are going to be massive opportunities. The key to preserve capital now, understand the dynamics at play, position yourself in areas that can weather the storm, and be ready to deploy aggressively when the signal comes. And what is that signal? It's not just rate cuts. Rate cuts to zero is step one, but the real signal is when the Fed turns the money printer back on, when they announce QE, when they start buying assets and injecting liquidity into the system. That's when you know they're fighting deflation. That's when you know it's time to get aggressive again. We saw this in 2008. Rates went to zero. The market kept dropping for 6 months until the Fed announced QE in February 2009. That was the bottom. We saw in 2020. Rates went to zero in March, and the Fed immediately announced a massive QE. That was the bottom. The pattern's clear. Zero rates plus money printing equals the buy signal. We're not there yet, so be patient. Use this time to build cash, reduce debt exposure, research companies and sectors that are benefiting from the rotation, and position yourself for when that signal fires. In the meantime, add exposure to areas that are working right now. Pharma is one of those areas. Bristol Myers Squibb and Biogen, 2 specific names, represent compelling opportunities with near-term catalysts and attractive risk-reward profiles. Do your own research, understand the risks, make your own decisions, but don't ignore what's happening. This rotation is real. What are your thoughts on this rotation? Are you seeing opportunities in pharma or any of the other sectors we talked about? Are you holding positions in areas that are getting hit? And if so, what's your plan? Have you looked at Bristol Myers or Biogen? Let me know down below. I love hearing from you guys and getting your perspectives. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily 15-minute recordings on market analysis, head over to stockscommunity.com. Try my Discord for just $25 for 7 days. Plus, if you want market updates I can't share on YouTube, sign up at free.stockscommunity.com. If you found this valuable, smash that like button, subscribe to the channel, send me a cough drop, and share this with somebody who needs to hear it. Markets are always moving, rotations are always happening, and understanding the flow of capital is one of the most important skills you can develop as an investor. This economic reset is real, it's happening right now, and the people who understand it and position themselves accordingly are going to make serious money while everyone else is panicking. This is the opportunity. Let's make 2026 your best year yet in the markets.